Hello and welcome back to JA Insurance. I'm your lovely host, Joshua Akindoli, and today you see the title. We're going to be talking about what are the pros and cons to an IUL policy. If you're watching this video, more than likely somebody has come across and tried to sell you an IUL at some point in time. Fair game. There's some agents who are truly sold on these products. They believe in them. They think it's the greatest thing ever. But like we all know, no matter how old you are, you know that there's no such thing as a one-size-fits-all perfect solution. Everything in life has its good and its bad, the yin and the yang. So what are the pros of IUL? You've heard them all. I'm sure you've heard them 1,000 times. Oh, you take no losses. You can never have a loss in your policy. The great, amazing returns. You have limitless returns. The limitless returns, and the flexibility. You can use this thing. You can become your own bank. You just gotta. You've heard it all. So I don't want to really harp too much on the pros today. And if you guys want me to talk about the pros and how you could possibly use it for certain things, just comment down below. Really, I'm here to talk about the cons because it seems like the cons are never spoken about, except by Dave Ramsey. But he doesn't go into details the way I'm going to go into details today. So when it comes to an IUL, remember a few things. Number one, an illustration is just an illustration. There's no way in God's green earth that you are going to have a policy that looks exactly like your illustration. Why? Remember this, within IUL, the only way your policy gets credited is if the market grows by a certain amount. Usually it's upwards of 7, 8, 9, 10%. So it has to grow above that for you to get credited in your policy. So if the market is flat in a particular year, which happens often, we've seen a few of those years. If the market is flat, your policy gets no credit. So that's a year where there's nothing coming in. So that throws off your cash value immediately. And you can imagine, every 4 years, let's say there's one or two on average. Let's say there's 1.50 years, flat years. Let's say there's 1 or 2 flat years every 4 years. That throws off your policy big time. Because we all know, the market is not going to just keep growing exponentially. It doesn't happen like that. So understand that an illustration is just an illustration. Which leads me to my second point. These things can take a long time to break even. Always think about the break-even point. The break-even point is when the amount that you contributed into your policy is equal to the amount you can borrow from. Because that's the selling point. You can borrow from your money tax-free. You could use this tax-free. Well, number one, you can't tax loans. And the money's already been taxed. So don't fall too much for that thing. But remember, when is my break-even year? Okay, you told me, the life insurance agent told you that you can become your own bank and you can start buying things however you want and you could do X, Y, and Z. Okay, so you want to buy, let's say you want to buy a car, for instance. You need $20,000. And I saw a guy make an example like this. I'm going to link that clip right here. Look at this. Okay, you want to buy a car for $20,000. That, number one, means you need $20,000 of cash value into your life insurance. You know what that usually means? You need to pay $20,000 into your life insurance. So in his example, he says, you can get a credit card, take $20,000 off, buy the car, borrow $20,000 from your life insurance policy, and then pay back that money into your credit card. It just sounds ridiculous, doesn't it? It sounds really ridiculous. And it is ridiculous. Unless you have ample money. If you got it and you have enough money to just throw premium in there and you're not really concerned about it, fine, it's for you. But if you're looking to buy a car with this whole infinite banking method, just remember this. Your break-even year is not going to come until at least 11 years sometimes. 7 years, 8 years. Because there's going to be years in your IUL where you're not getting nothing, where you're getting absolutely nothing. So that illustration that shows you it breaks even at 5 years, it's really going to be like 7 years or 8 years, depending on how the market is at the time. And do not let any life insurance agent convince you otherwise. The break-even year matters. Because remember this, you put $100,000 into your policy, and now you can only borrow $100,000 7 years later. How much of price is going up since 7 years? How much could you have made if you had invested that money elsewhere? So there's opportunity cost, there's inflation cost. Do not just be sold on that policy. And if it sounds too good to be true, a lot of the time it is. You do probably have a spending problem. I've had a spending problem where I got into a lot of debt. I mean consumer debt. I still got my student loans I'm paying off. But I mean consumer debt because I was just buying things, thinking 10 steps ahead instead of being resourceful and content at times. There's nothing wrong with wanting better things. But going about getting them the right way is what really matters. Don't fund somebody else's ability to buy a car. Don't be that guy that gets sold on an IUL and then now you're thinking you're gonna buy cars and do all kind of deals and flip and do this and become a real estate mogul. It's not like that. Your break-even year matters. You can only borrow according to what you put in for the majority of the years that you start. It's only after 8 years, 9 years, 10 years, depending on how your policy grows, that you start to see growth outside the policy. Like you see growth above what you put into it. This is seldom spoken about. But your policy can easily lapse. Your policy can easily lapse. If you go into this thing and you take a big loan out of, let's say you do a lump sum premium, you put 1 year premium. That first year on your policy anniversary, so you put $20,000 in today, 12 months from now, they're gonna credit you with your cash value. And you know what you're gonna see in there? Maybe $10,000. So let's say you say, all right, I want to get started with my infinite banking. I know my money, they say your money's still growing. You take out $10,000. If you are not paying back the interest in a timely manner, and let's say the interest is 4% per year, and let's say you get 2 years in a row where the market is flat, which we've seen in recent time. So you're counting on the growth to like take away the interest, but those 2 years it doesn't. Now your policy's in danger of lapsing. What do? You already got that 10,000 that you took up is all caught up. You put 20,000 into this thing already. Now you're in a big mess. Not all that glitters is gold. And finally, it just came to my mind again. Your surrender value. Do not let anybody convince you that this doesn't matter. You got to think 7 years is a long time. I'm not very old. I'm 26. But I can only think back to think that, okay, if I was contributing 10% of my income, let's say $5,000 for the last 7 years, and I just woke up today and I saw $35,000 of cash value in my life insurance policy, I'd be livid. For the last 7 years, you had me putting $5,000 a year, and now I can only borrow $35,000. That's exactly what I put in there. So if I just get up and I'm like, you know what, I'm done. Just give me my 35 back. I'm gonna take my opportunity cost lost, and I'm gonna take my inflation cost loss. It's all right. I'll take my loss. Get this, you take more loss because you only get the surrender value. Your surrender value might be $32,000, $30,000. These are just things I want you to keep in mind. And IUL very well might be for you. It very well might be for you. But these are real scenarios that happen, and they happen often. There's lawsuits, class action suits against life insurance agents who sold these things. Because people look at they look at their policy and they look at the results, and it's not what they were promised. It's not what they were guaranteed. And all things being equal, forget it. You should have moral integrity as a financial advisor, as any kind of salesman. Have that integrity to say, listen, I'd rather lose a sale. I'd rather destroy my own sale and lose money in my pocket than have that burden on my spirit, on my conscience. A lot of us profess to believe in one faith or the other, but when it comes to making a dollar, we're so quick to jump in and sell something that you wouldn't do for the Bible says treat your neighbor as yourself. So I wouldn't sell this thing to myself at this particular point in time. God willing, in the future, if my income significantly increases the way I want it to, sure, it's gonna be an opportunity for me. But for most of us, it's not the route to go. With all that being said, I hope you guys got some value out of this video. I hope you guys learned something today. And before I forget, if you're looking for prices on life insurance for either yourself, your family members, whomever else, go over to our website, jainsurance.info. You get free prices. We are not going to email you. I'm not going to wake, you're not going to, as much as you may desire, I'm not going to wake you up with a phone call trying to tell you something. When you're ready, on your own time, and if you ever are ready, we only ask you come back to home and do business with us. All right? So we love you. We're grateful to see you here. We're glad that you're alive. And hope to see you at the next one. All right now. Take care.